Hello there everyone, today we're going to have a quick look at a company buyback of own shares. Now what is this? Why might you do one? When is it applicable? What are the tax consequences? So let's just have a little look at a diagram here. Mr. A and Mr. B, and they are 50% shareholders each in, imaginatively titled, AB Limited. So this company making widgets, been doing all right for many years, and this guy here, Mr. B, says, you know what, I've had enough, I want to retire. Mr. A, he's like, I've got years left in me, I don't want to retire, I'm not ready to sell the business and get out here, I want to keep going. So divergence of motives and what they want to do next. So happens all the time, I've seen it thousands of times over the years. These two guys working in harmony for years, all of a sudden get to a crossroads. One guy wants to keep going, one guy wants to get out. So it ain't going to be sold to a third party. So how does this guy get out? Well, basically, there are a few choices. Number one, Mr. A can just buy him out. His business partner, fellow director, shareholder, call him what you will. He can just buy him out personally. But let's assume that Mr. A only has a spare 100 grand knocking about of readies that he can raise personally, doesn't want to go to a bank, doesn't want to raise any finance, any debt to then pay this guy. Because let's assume business is worth £1 million. So Mr. A, Mr. B, they're 50% share worth 500 grand each. So Mr. A, he's got about a liquid of about 100, doesn't want to borrow another 400, so he can't personally buy out Mr. B. However, let's have a look at the cash reserves of the business. So the cash reserves of the business, like I said, business doing very well for many years. They built it up. They haven't rinsed it every year. It's got $750,000 knocking about on the balance sheet in cash. Okay, so 750 grand. So what about this? What if the company buys back Mr. B's shares? So not Mr. A personally buying shares of Mr. B, but the company buying Mr. B's shares. So company literally writes a check to Mr. B for $500,000, still left with $250,000 of cash on the balance sheet, and Mr. B goes off into the sunset. Happy days. Mr. A has the business 100% at that point, because those shares that Mr. B had, they get cancelled. So the company is effectively 100% in Mr. A. AB Limited, you might want to change it to A Limited, but it's his sole business now. He doesn't have a business partner anymore, and Mr. B is out of the picture. So if this applies to you, if you're running an SME business with a business partner right now, and you have this divergence of motives and goals, one of you wants to get out, seriously consider company buyback of own shares, particularly if there are a few readies actually in the limited company. Now, from a tax point of view, let's have a look at the analysis of the tax. So it's all about Mr. B, because he is he's selling shares. He's selling shares back to the company. Now, when you sell something, that's a capital gain. So capital gains tax. Now, there are various hoops that you have to jump through. I'm not going to go through them in this video, but basically certain things need to happen for this guy to get capital gains tax treatment when this transaction occurs, when he sells his shares back to the company. Certain things need to happen, like reduction in the number of hours he works, various things. Now, this guy's getting out, full stop. He wants to, never mind cut down his hours, just get out. It's relatively easy to do this. Other pitfalls are multiple completion stages where, you know, there's maybe payout on the drip, but assuming there's enough readies to pay him in one go, the hoops aren't too hard to get through to get capital gains tax treatment, because the alternative, which Mr. B wouldn't want, is income tax treatment. The rules say in the tax world, if this thing isn't done correctly, this payment to Mr. B of $500,000 can be taxed as if it was a dividend. And God forbid he doesn't want to be treated as if he'd received a dividend, because the highest rate of dividend tax is, what is it? It's about 39%. Yikes. Whereas the highest rate for capital gains tax, assuming business asset disposal relief or entrepreneurs relief applies, is 10%. So I think you'd rather pay 10% than 39% every day of the week. But it's not a sure thing that he will pay that 10%. Like I said, a few hoops to go through. So make sure if you're in this situation, you do seek professional advice. You don't just go, oh, right, yeah, I'll just pay him a few quid, off he goes, update the share register. A little bit more complicated than that. But broadly speaking, that's how it would work. Mr. B, he goes off into the sunset. He gets his entrepreneur's relief, which is 10% on the first million, assuming he hasn't had any capital gains in the future, in the previous years. So he's got his full allowance. Everyone gets the first million at 10%. In this case, he's got 500 grand. So in the future, he's got another 500 grand to play with. But if he's generally retiring, chances are he won't be having another significant capital gain like this in his lifetime. So he's got his entrepreneur's relief, 10%. Mr. A has got 100% control of the business. He owns 100% of the shares. The only other real tax to consider actually is the company buying the shares of Mr. B. There will be stamp duty. So you might think, hang on a minute, Simon, you haven't mentioned anything about any properties here. So I'm not talking about stamp duty land tax. I'm talking about stamp duty, the antiquated tax that's been around for hundreds of years, where you stamp a document on a transaction. It's a tax on transactions, on documents. We used to have a wax seal in the old days. Unfortunately, this archaic tax is still in existence for transactions, and it stands at 0.5%. So the limited company, when it shells out $500,000 to buy back the shares from Mr. B so that Mr. A has got full control, the limited company will pay stamp duty of 0.5% on that 500,000. So not big bucks, a couple of grand. So they're the tax implications. Company pays a couple of grand. Mr. B, 10% entrepreneurs relief, assuming he's, what's that? That's 10% of 500 grand, 50 grand. Yes, there may be some annual allowance to knock off, but they are the tax implications of doing a company buyback of own shares. Very useful to do. Like I said, if you've got two individuals parting of the ways, how do you get one of them out? What are the options? This is one of the options. So if you like this video, please do subscribe. And as always, I'll see you soon.